When a company goes public, the headlines celebrate it as a milestone. The founders ring a bell. Investors cheer. The valuation explodes. And millions of people suddenly get the chance to own a piece of the business. But hidden behind that celebration is a strange question. If the people who know the company best have spent years trying to build ownership, why is this the exact moment they begin selling part of it? Is an IPO the beginning of a new journey or the end of an old one? The answer is neither. Because an IPO is not just a financial event. It is the moment a company stops being understood by a small group of insiders and starts being valued by the beliefs of the crowd. For most people, an IPO looks simple. A company grows. It needs capital. It sells shares to the public. Everyone wins. That is the version we are taught. And sometimes it is true. Some companies use public money to expand into new markets, build new products, and create enormous value for shareholders over the decades that follow. But that is only one side of the story. Because when a company reaches the IPO stage, something else is happening at the same time. Early investors who waited for years finally gain liquidity. Venture capital firms get a path to exit. Founders can turn part of their paper wealth into real wealth. Investment banks earn fees for bringing the deal to market. And new investors arrive, hoping to participate in the next chapter of growth. Everyone is looking at the same event, yet everyone is playing a different game. The founder sees 10 years behind him. The venture capitalist sees an investment cycle. The banker sees a transaction. The public sees an opportunity. An IPO is not simply about raising money. It is the rare moment when all of these interests meet in one place, under one price, and under one story. The common debate around IPOs is usually framed the wrong way. People ask whether an IPO is a great opportunity or a sophisticated trap. But that question assumes there is only one truth. There isn't. Because an IPO is one of the few events in business where multiple truths can exist at the same time. A founder can genuinely believe in the future of the company while selling some shares. A venture capital fund can be exiting not because the business is failing, but because its job was never to stay forever. A public investor can buy at the IPO and still make extraordinary returns if the company continues to execute. And another investor can lose money despite buying the exact same stock. The difference is not the company. The difference is what each person believes they are buying. Most people think an IPO is the sale of ownership. In reality, ownership is only the surface. What is really being traded is belief. Belief about future revenue. Belief about future growth. Belief about future dominance. Belief about a future that has not happened yet. And that is why IPOs create both fortunes and disasters. Because the moment a company goes public, its value is no longer determined only by what it is. It begins to be shaped by what millions of people think it could become. At Mind Over System, we are less interested in whether something is good or bad. We are interested in understanding the incentives beneath it. Because once you understand the system, you stop reacting to headlines. And you start seeing why people make the decisions they do. Before an IPO, a company lives in a very different world. Most people never see that world because private companies operate behind closed doors. There are no millions of shareholders, no daily stock price, no endless stream of market opinions. Ownership is concentrated in the hands of a small group of people: founders, early employees, venture capital firms, and a few major investors. More importantly, understanding is concentrated there too. The founder knows why certain decisions were made years ago. The leadership team knows which numbers are improving and which ones are being held together by temporary solutions. Early investors know what risks still exist beneath the surface. They may disagree about the future, but they all share one advantage: proximity. They are close enough to the business to see details that the outside world cannot. This is what makes a private company fundamentally different from a public one. Not the size, not the revenue, not even the profitability. The difference is that ownership and understanding largely belong to the same group of people. The people who own the most are often the people who know the most. But that arrangement cannot last forever. As the company grows, early investors eventually want liquidity. Employees want the freedom to turn years of work into something tangible. Founders may want capital for expansion or simply a broader base of ownership. And sooner or later, the company reaches a point where the small circle is no longer enough. That is when the next stage begins. Not the transfer of shares, the transfer of belief. Nothing dramatic happens to the business on the day of an IPO. The products do not suddenly become better. The customers do not suddenly buy more. The company does not wake up as a different company. Yet something extraordinary happens. For the first time, the value of the business is no longer determined primarily by the people closest to it. It becomes exposed to the judgment of millions of people who know it only from the outside. And that changes everything. Before an IPO, a company is evaluated through direct knowledge. After an IPO, it is evaluated through expectations. This is why two people can look at the same company and arrive at completely different conclusions. One sees its current revenue. Another sees the market it could dominate 10 years from now. One sees today's profit. Another sees tomorrow's possibility. The market gathers all of these competing views and compresses them into a single number, the stock price. But that number is often misunderstood. Many people treat it as a measurement of value. In reality, it is a measurement of belief. A stock price is not telling you what a company is worth. It is telling you what enough people are willing to believe about its future. This is the hidden transformation that occurs during an IPO. The company itself may remain largely unchanged, but the source of its valuation changes completely. It moves from knowledge to expectation, from information to interpretation, from the understanding of a few to the belief of the crowd. And once that transition happens, the future of the stock depends on something far more unstable than business performance alone. It depends on whether reality can keep up with the expectations that created the price in the first place. This is where IPOs earn both their greatest successes and their worst reputations. Because once a company becomes publicly traded, two realities begin moving side by side. The first is business reality: revenue, profitability, execution, competition, innovation. The second is market expectation: what investors believe will happen. For a while, those two realities can move very far apart. A company can be worth billions despite producing little profit because investors believe its future will be extraordinary. Another company can generate strong profits yet receive little attention because investors see limited growth ahead. The market is not rewarding the present. It is constantly trying to price the future, and that creates a gap. Sometimes reality eventually exceeds expectations. The company grows faster than predicted. The products become more valuable than imagined. The market opportunity turns out to be larger than anyone expected. When that happens, the IPO becomes the beginning of a remarkable story. Not because the IPO created success, but because reality continued to outperform belief. Other times, the opposite happens. The story is compelling. The projections are ambitious. The expectations become enormous. But the business struggles to deliver what investors already priced in. When reality falls short of belief, the gap begins to close. And stock prices often fall long before the company itself appears broken. This is why IPOs can look so confusing from the outside. Two companies may enter the market with the same excitement, the same media attention, and the same optimism. Years later, one becomes a legendary investment, while the other becomes a cautionary tale. The difference is rarely the IPO itself. The difference is whether reality was strong enough to justify the expectations attached to it. And that may be the most important thing to understand about an IPO. It is not a celebration. It is not a warning sign. It is not proof of success. And it is not evidence of failure. It is simply the moment when a company's future receives a public price. From that point forward, the market begins a continuous experiment, comparing belief against reality, again and again, year after year, and eventually, reality always wins. History offers countless examples of this pattern. Some of the most successful IPOs in history were not successful because investors were excited. They were successful because the businesses eventually delivered more than the market expected. Amazon spent years being criticized for prioritizing growth over profits. Many investors questioned its valuation. Yet over time, the company expanded into industries that few people fully anticipated, and reality eventually exceeded even ambitious expectations. Other companies followed the opposite path. They entered public markets, surrounded by optimism, media attention, and enormous valuations. Investors projected years of rapid growth before that growth had actually occurred. But expectations can rise much faster than businesses can execute. When those expectations proved too aggressive, valuations fell even when the companies themselves continued operating. This is an important distinction. A declining stock price does not always mean a company is failing. Sometimes it simply means the future turned out to be smaller than investors imagined. The lesson is not that IPOs are opportunities, nor that IPOs are traps. The lesson is that public markets are constantly making predictions about the future, and every IPO begins with the same question. How much of that future has already been priced in? Imagine two investors looking at the exact same IPO. Both read the same reports. Both see the same valuation. Both buy shares on the same day. Yet, 10 years later, one calls it the best investment of his life, while the other calls it a mistake. What changed? Not the company. The company was the same for both of them. The difference was the story each investor believed he was buying. The first investor looked at the business and asked, if this company succeeds, how large could it become? The second investor looked at the stock price and asked, how much higher can this go from here? At first, those questions seem similar, but they are not. One is focused on business potential. The other is focused on market expectations. A company can become significantly larger over the next decade and still produce disappointing returns if investors already expected even more. Likewise, a company can deliver excellent returns despite modest growth if expectations were initially too low. This is the paradox that confuses many people about IPOs. People often assume they are investing in a company. In reality, they are investing in the gap between what the company eventually becomes and what everyone already believes it will become. That gap is where gains are created, and it is also where losses begin. The company builds the future. The market attempts to predict it. The distance between those two things determines almost everything that follows. This is why IPOs often confuse people. A great company does not automatically become a great investment. What matters is not only what the business becomes, it is whether reality becomes greater than the expectations already built into the price. The same pattern appears far beyond IPOs. It appears in technology booms, in real estate cycles, in cryptocurrency markets, and in almost every period of collective optimism throughout history. When excitement rises, people begin paying not for what exists, but for what they imagine could exist. At first, that process creates wealth. Then, it creates expectations. And eventually, those expectations become so large that reality struggles to catch them. The moment that happens, disappointment becomes almost inevitable. Not because the asset was bad, not because the business failed, but because belief ran faster than reality. And every IPO sits directly at the intersection of those two forces. Reality on one side, expectation on the other, waiting to see which one moves first. Perhaps the biggest misconception about IPOs is that people think they are buying a company. They are not. The company already exists. Its products exist. Its customers exist. Its strengths and weaknesses already exist. What investors are really buying is a version of the future, and every participant in the market is competing to estimate that future before everyone else does. This is why IPOs are neither celebrations nor warnings. They are moments of price discovery, moments when millions of people attempt to answer the same question. What will this business become? Some will be too optimistic. Some will be too pessimistic. Most will be wrong in one direction or the other. But over time, reality slowly removes those errors. The story becomes less important. The results become more important, and the price gradually moves toward what the business is actually capable of delivering. In the end, an IPO is not a test of belief. It is a test of whether belief can survive contact with reality. The next time you hear that a company is going public, resist the urge to immediately see it as either an opportunity or a warning sign. Instead, ask a different question. What expectations are being priced into this company today? Because an IPO is not the moment a business becomes valuable. It is the moment the public begins debating how valuable its future might be. And from that point on, the outcome depends on something no prospectus, analyst, or investor can fully know: whether reality will ultimately justify the belief. Every IPO begins with a story about growth, a story about possibility, a story about the future. Some of those stories eventually become reality. Many do not. The challenge is that nobody knows which is which at the beginning, and perhaps that is the real purpose of a market. Not to tell us what the future will be, but to reveal what people believe the future will be. Because in the end, every IPO starts with confidence. Only time decides whether that confidence was wisdom or illusion.